Malandrino, global markets reporter at Nasdaq. Joining us live from the market site in Times Square, New York City, we have Phil Mackintosh, chief economist at Nasdaq. And Phil, the cat is finally out of the bag, right? We finally got through this Fed meeting that everyone was anticipating. And, even looking at the market action up until this point, it kind of was a game of wait and see.
Pretty much as expected, really.
Yeah.
I mean, I know the market thinks the Fed is behind the curve, but what we saw with the expectations for rate hikes next year is pretty much where the Fed's come out today and said they want to do. And so the market's up a little bit, but not too much.
Yeah, so the $30 billion tapering, we knew that was coming. We could see in the chart here, the 3 rate hikes for 2022. That was also in the data.
Yep. Yeah, I mean, the market really hasn't reacted strongly because the market pretty much guessed right.
And I think the biggest conversation is going to be around inflation, of course. That really seems to be what the Fed is predicating, in addition to the employment situation, but really it comes back to inflation.
Yeah, I mean, Chow Powell was talking about how we're getting pretty close to their employment goals as well right now. So that really takes away that as the handbrake to reacting to inflation, which is well and truly above their sort of target levels of 2% on average. If you look at some of the data recently during this week, the PPI, which is the producer inflation basically, was extremely high. It's up close to 10% now. So the more I talk to companies, the more I hear that as well. The cost of importing goods, the cost of inputs to manufacturing are going up. Wages are going up, so the costs for companies are going up. And we've seen in the earnings cycle that they've been able to raise prices as well. It's feeding through to inflation, but it's broader inflation now because of that. It's not transient anymore, and it looks like it might stick around.
Well, of course, for the second winter in a row, COVID, again, is a major variable in this, and it's kind of, there are a number of variables here. We're getting, record number of cases again. However, the efficacy of these vaccinations with boosters seems to be doing its job.
Yeah, I mean, since we talked last, we've had a huge increase in those South African cases. So we know that the COVID, the Omicron variant, is very contagious, which we sort of thought was true, but we haven't seen the hospitalizations yet. It's probably still a little early, but in the meantime, some of the research on the effectiveness of vaccines, the effectiveness of some of the antivirals, the new pill that Merck and Pfizer have is really promising. So hopefully, fingers crossed, it's not as bad as the Delta wave because it doesn't send so many people to hospital and cause shutdowns of factories.
Right. Well, I mean, we've also have a higher number of people vaccinated at this point as well, which is certainly encouraging. Let's talk about something that was a bright spot in the market. ETF and IPOs for this year was quite remarkable.
Huge year. Globally, about $1 trillion has gone into ETFs, over $600 billion into IPOs, record numbers for past decades plus on both fronts. It's kind of interesting because on the ETF front, we've seen a lot of new ETFs come to market because of a lot of flows into them. Not so many ETFs shutting down. So really positive market for that side of the industry. And on the IPO front, we've had over 1,000 new companies come to market in the last 12 months. So that's fantastic for public markets and public investing.
So do you get this question a lot? Is this reminiscent of the 90s when we saw that burst of IPOs?
I mean, it's the perennial question, and the valuations are kind of in line. But what's different this year is the interest rates, 1.5, even if the Fed takes it up to 2.5 in a year, are still way below the interest rates when we had the tech bubble, which was 6 to 7%. And so the valuation pressure is totally different. And I think if you look at where valuations sort of trend along that interest rate curve, where we are now is not so rich compared to where we were when a 6% interest, same PE, much richer environment. So, provided earnings can hold up, and that's where the inflation question comes back again. The market's not that rich. It's definitely not rich like it was back in the 90s.
Is it possible we could see this slew of deal activity and new issuances in 2022?
I think the pipeline's reasonably strong. One of the things that happened this year, a lot of the IPOs were SPACs, and so they might take some of the private companies public by absorbing them and doing mergers and acquisitions. It'll be interesting to see how many companies come directly to the public markets.
Well, that's one way to keep deal flow active. All right, Phil, thank you as always for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.